For most people, the health savings account functions like a temporary debit card. You load money from your paycheck, swipe it at the pharmacy for prescriptions or copays, and move on. Most users drain their account balance to zero by December and start the exact same cycle over again in January. By treating the account as a simple spending tool, the average person is overlooking the specific way this money could compound if left untouched. The tax code classifies this as a healthcare vehicle, but the mathematical rules governing its growth mirror and in some cases exceed the benefits of a 401k or a Roth IRA. To understand why these numbers diverge so drastically, we have to look past the pharmacy counter and check the specific rules written into the IRS code. The foundation of this account rests on a specific mechanism called the triple tax advantage. We can see the difference by comparing the three major retirement options. With a traditional 401k, you get a tax break on the money going in, but the IRS taxes you on the way out. A Roth IRA does the opposite. You pay taxes on the front end, so your withdrawals are tax-free. The HSA bypasses the IRS at all three stages. The money you contribute is deducted from your taxable income, the money grows untouched by capital gains taxes, and when you withdraw it for healthcare, you owe zero income tax. This chart shows what those three layers actually produce over time. If you take $1,000 and invest it at a 7% return for 30 years, a standard IRA in a 22% tax bracket leaves you with roughly $5,900. That same investment in an HSA yields over $7,600. That creates a $1,700 gap on a single $1,000 contribution. It is a mathematical margin that traditional retirement accounts cannot overcome. Many people hesitate to fund this account because they assume the money is strictly reserved for current medical bills. But healthcare is a guaranteed expense of aging. Fidelity estimates that a single person retiring today at age 65 will need $172,500 just to cover their baseline medical costs. The HSA is designed to fill that hole, but a specific IRS loophole allows you to use the money far more flexibly. There is no statute of limitations on when you must reimburse yourself for an expense. This enables a strategy where you pay for a $400 dental bill today using your regular checking account. You keep the physical or digital receipt in a folder. Because you didn't raid the HSA to pay that bill, the equivalent $400 stays in the market, compounding entirely untouched. Decades later, if you want to fund a vacation, you can pull out that original receipt and reimburse yourself from the HSA. You have successfully pulled money out of a retirement account completely tax-free because the dental work happened after the account was opened. This delayed reimbursement effectively turns a folder of old medical bills into a tax-free coupon book for your retirement lifestyle. But what if you are exceptionally healthy and never accrue enough medical receipts to empty the account? Before age 65, the IRS protects the account with a 20% penalty on any withdrawals made for non-medical reasons. However, once you turn 65, that 20% penalty disappears. You can withdraw money for any reason, a new car, travel, or general living expenses, and you simply pay ordinary income tax on the withdrawal. At age 65, the HSA becomes the functional equivalent of a traditional 401k if you use it for non-medical items. But if you use it for healthcare, it remains tax-free. In the worst-case scenario, it ties the 401k. In the best case, it remains superior. Consider a 28-year-old worker choosing between health plans. She opts for the high-deductible health plan, or HDHP, which is the only plan that allows for an HSA. She takes the money she saves on the lower monthly premiums and routes the maximum allowable contribution into her HSA every year. She then avoids the most common mistake, letting the money sit in a cash account. Instead, she moves the balance into a broad market index fund. By paying for small expenses out of pocket and letting her investments compound for decades, she builds a balance that can reach the high six figures by retirement. Checking a different box on a benefits form at age 28 creates a trajectory where her healthcare costs in retirement are already paid for before she even stops working. Because of this three-way tax advantage, many financial planners are now adjusting the standard order of operations for saving money. The hierarchy often starts with securing your employer's 401k match, followed immediately by maxing out the HSA. Only then do you move on to the Roth IRA and the remainder of your 401k. This strategy does require a caveat. It is only viable if the underlying high-deductible health plan fits your life. If you have chronic medical needs or frequent hospital visits, the high out-of-pocket costs of the plan could outweigh the long-term tax benefits. However, if the math aligns with your health, the HSA provides a unique combination of tax advantages that no other retirement account in the United States can match.